The Kansas City Approach to Modern Money Theory by L. Randall Wray. Section 9. Conclusion. MMT and Policy. Much of MMT is descriptive, explaining how sovereign currency works, as well identifying the policy space open to a sovereign currency issuer. The descriptive part can be used by either progressives or conservatives to formulate policy. MMT's developers are largely progressive, but have sought to explain how the monetary system in place works, with a view to exposing fallacies held by both the right and the left. For the most part, the descriptive part of MMT can be separated from the policies advocated by MMT's proponents. However, we see three policies as following directly from MMT: the job guarantee, flexible exchange rates, and interest rate targeting. Some critics claim that the job guarantee is not essential to MMT. They see it as, at best, an optional policy that some progressive proponents of MMT have unnecessarily added. This is false. All of MMT's developers, including Warren Mosler as well as the Newcastle approach of Bill Mitchell, have included the job guarantee from the beginning as one of the fundamental policies. MMT sees the job guarantee as the most important policy to regulate the value of a sovereign currency. As discussed above, MMT argues that taxes drive money, in the sense that obligations create the initial demand for the sovereign's currency. This ensures that currency will have some value. However, MMT insists that the value is determined by what one must do to obtain the currency. If one must work for 1 hour to obtain $15, that establishes the value of the currency. 1 hour of labor equals $15. If a job guarantee program pays $15 as the basic wage, this ensures that anyone willing to work will be able to obtain that wage. Other employers will have to at least match the wage. Workers of higher skill or otherwise in greater demand will receive higher pay, as other employers try to bid them away from the job guarantee program. MMT views the sovereign government as the price setter and quantity taker through the job guarantee program. As in Minsky's approach, MMT argues that the job guarantee is a stabilizer of employment, wages, aggregate demand, and prices. Setting the base wage and operating a buffer stock of labor helps to directly stabilize wages and prices more effectively than simply trying to rely on aggregate demand stabilization. Further, by using the job guarantee as the major anti-unemployment policy, it will not promote financial instability. As Minsky argued, choosing the typical conservative supply-side policy of tax cuts for the rich or subsidizing investment can encourage speculative booms, as does the typical Keynesian pump priming aimed at the most advanced industrial sectors. Such policies increase inequality, which over recent decades has forced at least the bottom half of the distribution to rely on debt to maintain living standards. The job guarantee instead provides jobs and can be used to raise wages at the bottom, enhancing equality and reducing the tendency toward financial fragility. For these reasons, the job guarantee is an essential component of MMT. The other two policies that are fundamental to MMT are flexible exchange rates and interest rate targeting by the central bank. Flexible exchange rates maximize policy space and eliminate the danger of forced default by government on its domestic currency obligations. A country that pegs to precious metal or to a foreign currency must have adequate access to the metal or foreign currency. Since it has promised to convert at a fixed exchange rate, both its currency and its bonds are effectively claims on the metal or foreign currency. To ensure it can meet those claims, its domestic policy must be shaped by the need to maintain adequate reserves for conversion. This generally means austerity policy to run current account surpluses and or to please suppliers of the metal or foreign currency through the capital account. MMT proponents do not necessarily claim that every country should float. They simply argue that the domestic policy advantages of issuing a sovereign currency are not available to a nation that doesn't float. In some cases, pegging or maintaining an exchange rate might be the best policy for an individual nation. MMT has always accepted the horizontalist view that the central bank sets the overnight interest rate target and then accommodates the demand for reserves, a view that is now also commonly accepted by central bankers. In difference to conventional views and those of some followers of the horizontalist approach, however, MMT does not support use of interest rate policy to manage demand and indirectly to manage inflation. First, there is little evidence that spending is sufficiently interest elastic to enable a central bank to have much influence over aggregate demand within the normal range of interest rate targets. Second, there is little evidence that central bank interest rate policy or even the non-traditional quantitative easing and negative interest rate policies of the past decade has been able to move inflation rates in desired directions. Third, while sharp increases to very high interest rates, such as those produced by Volcker's experiment in monetarism after 1979, can break a speculative bubble, they do so by present value rehearsals, insolvencies, bankruptcies, and financial crises. The cost of these episodes are great, and it is likely that credit controls as well as tighter regulation of financial institutions would be more effective. For these reasons, MMT proposes greater reliance on fiscal policy, as well as more focus on quantitative and qualitative control of financial institutions rather than manipulation of interest rates. MMT prefers a low and stable interest rate target. Because MMT recognizes that government bonds are not really a borrowing operation, and instead should be seen as a tool of interest rate policy, it sees interest payments on reserves as a viable alternative to issuing bonds, as either will serve to keep the overnight rate in line with the interest rate target. For this purpose, short-term bonds are sufficient, that is, 1 to 3 months, as they serve as a good substitute for interest on reserves. Minsky and MMT both see interest payment by government as a generally inefficient form of government spending. It tends to go to high-income individuals, to institutional holders, and to foreigners. For this reason, the interest rate target should be kept low. Further, as Keynes argued, the policy rate sets the base interest rate for the economy. The higher the target, the greater the hurdle that must be reached for alternative investments. All else equal, high interest rates reduce investment that would be in the private and public interests, while the national government can always make interest payments no matter how high they might be. Subnational governments are in a different position, and interest costs on their public infrastructure can significantly increase total costs faced. Keynes advocated euthanasia of the rentier through eliminating interest on risk-free debt. Interest would be a reward only for taking risk. This is a recommendation for permanent zero interest rate policy, ZIRP, and it has been adopted by MMT proponents such as Bill Mitchell, Warren Mosler, and Matt Forstater. While I agree with this as a general policy, I can also see a public interest in offering risk-free savings bonds to individuals, pension funds, and insurance companies. Only qualifying buyers would be allowed to hold them, with income and wealth caps for individuals and conditions placed on institutional holders, and the interest rate would be set by Congress or Parliament. These are the basic policies accepted by all the developers of MMT. Of course, proponents of MMT also have formulated other policy proposals to promote the public purpose. While these do not necessarily follow from the tenets of MMT, understanding how modern money works helps to delineate what is financially possible. Of course, MMT can also be used by conservatives to formulate policy that is not in the public interest, such as foreign wars to subjugate other peoples or policies to increase inequality in order to benefit the lucky few. While we recognize that this is a danger, it can be avoided only by arming progressive movements with the understanding they need to counter the claims that government cannot afford to spend in the public interest. Given a choice between explaining how government currency works versus perpetuating lies about budgeting, lies that have been propagated by anti-democratic elites that fear their status could be challenged by the truth, MMT chooses to enhance understanding.